Picture this, 1570. A merchant in Lisbon wakes up to find that the currency he's been using for trade, the Portuguese real, the most trusted money in the world for 80 years, is suddenly worthless. Not because of war, not because of invasion, because of a pattern so predictable, so mathematical, that it has destroyed every single reserve currency in recorded history. Not most of them, every single one. The Portuguese real, 80 years, dead. The Dutch guilder, 80 years, gone. The British pound, 105 years, collapsed. The dollar became the world's reserve currency in 1944. That was 81 years ago, and right now, in 2025, the dollar is sitting in stage 5 of this 7-stage cycle. Stage 5, and if you don't know what stage 6 looks like, let me tell you. It's when the British pound lost 40 percentage points of global reserve share in 15 years, when nations scrambled for exits, when savings evaporated. So here's the question you need to ask yourself. Are you paying attention, or are you about to become the liquidity in the largest wealth transfer in human history? Because understanding this pattern isn't about economics, it's about survival. It's about recognizing that your dollars, your paycheck, your retirement account, everything denominated in this currency is sitting on a timeline that has played out 4 times across 6 centuries. And every single time, the people holding the old currency when stage 7 hit got wiped out. Not because they were stupid, because they didn't see the pattern. So let me show you what every empire that ever collapsed missed. Let me show you the 7 stages. Let me show you exactly where we are. And more importantly, let me show you the one number that nobody is talking about that tells you we are further along this path than almost anyone realizes. Now, before we go further, you need to understand what a reserve currency actually is. Because this isn't just about a strong currency. A reserve currency is the money that other nations stockpile in their central banks. It's the currency that oil is priced in. It's the currency that international trade is settled in. When you're the reserve currency, every country on earth needs your money just to function. They need it to buy oil. They need it to settle trade imbalances. They need it to hold safe assets. And this creates something called exorbitant privilege. You get to print money and exchange it for real goods. You get to run endless deficits because foreign nations have to accumulate your currency just to participate in global trade. You get to borrow at artificially low interest rates because demand for your bonds is structural. It is the ultimate economic weapon, and it is why empires kill to get it and why they die when they lose it. Stage 1 is military dominance over trade routes. Every reserve currency in history started the same way. Overwhelming military power that controlled the pathways of global commerce. Not just having a strong military, controlling the choke points where trade flows. In the 1450s, Portugal did something no one else could. They mastered open ocean navigation. While everyone else hugged coastlines, Portuguese sailors crossed oceans. They rounded the Cape of Good Hope in 1488, opening a sea route to Asia that bypassed the Ottomans. And then they militarized it. Portuguese warships dominated the Indian Ocean, the South China Sea, the Atlantic. They built fortified trading posts at every choke point: Goa, Malacca, Macau, Mozambique. These weren't just ports, they were armed fortresses. If you wanted spices from the Moluccas, you dealt with Portugal. If you wanted to trade with India, you needed Portuguese permission. They charged fees, imposed tariffs, seized ships that tried to bypass them. And that military control made the Portuguese real the currency that mattered. Merchants across 3 continents needed reals to trade in Portuguese-controlled waters. Not because the real was backed by gold, because it was backed by cannons. The Dutch followed the same script in the 1600s. The Dutch East India Company wasn't just a business, it was a military power. 40 warships, 20,000 soldiers. They conquered Portuguese forts, seized the Spice Islands, and made Amsterdam the center of global trade. If you wanted to trade, you needed guilders. Britain perfected the model in the 1800s. At its peak, the Royal Navy had more warships than the next 5 nations combined. They controlled the Suez Canal, Gibraltar, Singapore, the Straits of Malacca. Every critical choke point was British. The pound became the global currency because British cannons made it impossible to trade without it. And the United States, after World War II, achieved the same position. 11 aircraft carrier battle groups, more than the rest of the world combined. Navy controls every ocean: Hormuz, Malacca, Suez, Panama, Bab el-Mandeb. This isn't defense, this is control, making it impossible for global trade to happen without American approval. That's stage 1. The dollar achieved it in 1945. Check. Stage 2. Massive trade surpluses. Once you control the trade routes, wealth starts flowing toward you. Portugal in the 1500s ran enormous surpluses. They bought spices and silk from Asia and sold European goods at 10 times markup. The balance of trade flowed to Lisbon. Portuguese crown revenues from trade were so large they funded the entire government without heavy domestic taxes. The Dutch in the 1600s turned this into a system. Amsterdam became the warehouse of the world. Goods from Asia, Africa, the Americas, all flowed through Amsterdam. The Dutch bought low, sold high, captured the spread. Their trade surplus was so massive that Amsterdam's merchants were richer than European kings. Britain in the 1800s ran the largest trade surplus in history up to that point. They exported manufactured goods to the world and imported raw materials at prices they dictated. The surplus built Britain into the wealthiest nation on earth. And the United States, from 1945 to 1970, had the most dramatic trade surplus ever. After World War II, America was the only industrial power with intact infrastructure, exported machinery, cars, steel, consumer goods to a rebuilding world. The surplus was so large that dollars flooded into foreign central banks faster than they could spend them. Gold reserves swelled. Fort Knox held over 20,000 tons by the 1950s, more than the rest of the world combined. That's stage 2. The dollar crushed it from 1945 to 1970. But here's where every reserve currency makes the same fatal mistake, because stage 2 doesn't last forever. Stage 3 is reserve currency status formalized. This is the peak, the moment of maximum power. For Portugal, it happened in the early 1500s when European and Asian merchants officially adopted the real for international trade. For the Dutch, it was the mid-1600s when the guilder became the standard for bills of exchange. Even the British East India Company used guilders because Amsterdam was the most liquid market in the world. For Britain, it happened at the Congress of Vienna in 1815. The pound was explicitly recognized as the global standard. International treaties, loans, trade contracts, all denominated in pounds. And for the United States, it happened at Bretton Woods in 1944. 44 nations met in New Hampshire and formally made the dollar the world's reserve. Other currencies would peg to the dollar. The dollar would peg to gold at $35 per ounce. The IMF and World Bank were created to manage this system. It was the most explicit formalization in history. But here's what nobody tells you. Stage 3 is the peak. This is as good as it gets. Because once you formalize reserve status, you plant the seeds of your own destruction. The world needs your currency more than your goods, so you stop producing. You start importing. The trade surplus reverses into a deficit, and the deficit becomes permanent. This is called the Triffin dilemma. Must run deficits, must send dollars abroad. But running endless deficits undermines the currency. You can't be the reserve and maintain a strong trade balance. It's mathematically impossible, so every reserve currency, once it hits stage 3, begins the irreversible slide into stage 4. Stage 4, deficit spending and living beyond your means. This is where the trap closes. Portugal in the mid-1500s stopped exporting and started importing everything: grain, textiles, manufactured goods. They paid with gold from Brazil, but they weren't producing wealth. They were consuming accumulated wealth. The Portuguese crown's spending exploded. Palaces, churches, the royal court, military expenses to hold the empire. They didn't notice the problem because Brazilian gold kept flowing. But the gold wasn't infinite, and they weren't building anything productive with it. They were just consuming. The Dutch in the 1700s did the same. After a century of surpluses, they became net importers. Why work in factories when you can live off capital? Dutch investment shifted from production to finance. They became bankers to Europe. This generates returns, but it's passive, not productive. The trade balance reversed. They imported more than they exported and paid for it by liquidating wealth. Britain in the early 1900s faced the same reversal. By 1900, Britain was running trade deficits. They imported food, raw materials, manufactured goods. They paid with returns on overseas investments. The investment income was enormous, but it was extracting wealth created elsewhere, not creating new wealth at home. British manufacturing declined. The trade deficit grew every year, living beyond their means, financed by selling off the past. And the United States entered stage 4 in 1971. That's when the trade surplus permanently flipped into deficit. By the 1980s, the deficit was exploding. America was running the largest trade deficit in history, $800 billion annually. America imports far more than it exports: electronics, cars, textiles, everything. How is this financed? By exporting dollars, printing currency and trading it for real goods. This only works because the dollar is the reserve currency. Other nations need dollars, so they accept them. But this is living beyond your means, consuming more than you produce. And it is the exact same pattern that killed every reserve currency before. Stage 5, currency debasement and money printing. When deficits become unsustainable, when borrowing isn't enough, you print. Portugal did it in the 1550s. Facing deficits and declining revenues, the crown began debasing the real. They reduced silver content in coins, issued more currency than metal. Inflation surged. Merchants refused reals or demanded more for goods. Purchasing power eroded. By the 1570s, international merchants started preferring other currencies. The Dutch did it in the 1700s. The guilder had been backed by conservative banking. But by the mid-1700s, the government was borrowing heavily for wars and colonies. When borrowing got too expensive, they inflated, printing money to cover deficits. The guilder's value declined. By the 1780s, it was no longer preferred for international trade. Britain debased the pound through 2 world wars. World War I forced them to print and abandon gold temporarily. World War II forced them off gold permanently. By 1945, the pound was floating and losing value. Britain printed to rebuild and fund the welfare state. The pound devalued repeatedly. 1949, 1967. Each devaluation eroded confidence. By the 1970s, the pound was no longer a reserve currency. It was regional. And the United States entered Stage 5 in 2008. The financial crisis forced the Fed to print on a scale never seen before. Quantitative easing. $3.5 trillion created from 2008 to 2014. Then COVID, $7 trillion more from 2020 to 2022. The money supply expanded faster than any time in peacetime history. This is debasement, not by reducing metal, by expanding supply. And the effect is identical. Purchasing power declines. Inflation surges. In 2021 and 2022, inflation hit levels not seen in 40 years. The difference this time is scale. The dollar is global. When the Fed prints, it exports inflation to the entire world. Other nations watch their dollar reserves lose value. And this is the stage where confidence begins to crack. Once confidence goes, Stage 6 follows fast. Stage 6, loss of confidence and the search for alternatives. This is when the world starts looking for the exits. Portugal lost confidence in the 1570s and 1580s. Merchants demanded Spanish silver or Venetian ducats instead of reals. Trade contracts switched to other currencies. Asian merchants who had accepted reals for decades started refusing them. By 1580, when Spain annexed Portugal, the real was already dead as a reserve. The annexation just formalized what the market had decided. The Dutch guilder lost confidence through the 1700s. France, Britain, others began holding reserves in different currencies. By the 1780s, Amsterdam was no longer the financial center. London was. The guilder was regional. The shift was gradual but irreversible. The British pound lost confidence rapidly after World War II. In 1945, Britain owed enormous war debts. The pound was overvalued, supported only by American loans. In 1949, Britain devalued the pound by 30%. International holders lost a third of value overnight. Confidence collapsed. Nations shifted reserves from pounds to dollars. By 1960, the pound's share of global reserves had fallen from over 60% in 1945 to less than 20%. The transition took 15 years. The dollar is in the early stages of Stage 6 right now. The signs are everywhere. China and Russia began reducing dollar reserves in the 2010s. They've been buying gold, thousands of tons. China's official reserves have more than doubled since 2008. Treasury holdings after 2014 sanctions. The BRICS nations have been discussing alternatives. In 2023, they announced plans for a BRICS currency. It hasn't launched, but the fact it's being discussed is huge. Saudi Arabia, which has priced oil in dollars since 1974, the foundation of the petrodollar, began accepting yuan for oil sales to China in 2023. This breaks a 50-year precedent. Central banks globally are diversifying. The dollar's share of global reserves has fallen from 72% in 2000 to 58% in 2024. That's 14 percentage points. It sounds small. It represents trillions shifted out of dollar assets. The euro, yuan, gold absorbed most of it. Even small nations are reducing exposure. Thailand, Malaysia, Indonesia, negotiating trade in local currencies instead of dollars. This is the beginning of Stage 6, the world searching for alternatives. Not because they hate America, because they see the same pattern that destroyed every reserve currency before. Endless deficits, debasement, loss of purchasing power. They're not waiting for Stage 7. They're positioning now. Stage 7, replacement and collapse. This is when a new currency rises to replace the old. Not through agreement, through market adoption. The world simply stops using the old and starts using the new. The Portuguese real was replaced by the Spanish silver peso in the late 1500s. Spain had conquered vast silver mines in the Americas, Potosi in Bolivia, Zacatecas in Mexico. These mines produced more silver than the world combined. Spanish coins became preferred because they were abundant, standardized, backed by production. The real, debased and declining, couldn't compete. Merchants refused it. By 1600, the real was irrelevant. The Dutch guilder was replaced by the British pound in the late 1700s and early 1800s. Britain's Industrial Revolution and naval dominance made the pound the obvious successor. London's markets became deeper than Amsterdam's. The transition took 30 years. By 1815, the pound was the undisputed standard. The guilder was regional. Dollar from 1945 to 1960. The transition was formalized at Bretton Woods, but took years to complete. Britain was bankrupt after World War II, held most of the world's gold and the only intact industrial base. The pound collapsed in devaluations. By 1967, the dollar had fully replaced it. So, what replaces the dollar? That's the question. And the answer isn't clear yet because we're not at stage 7. We're in stage 6, the search for alternatives. But history gives clues. The replacement comes from the nation with military dominance over trade routes, a trade surplus, and productive capacity. Right now, that's not any single nation. China has surplus in production, but doesn't control trade routes militarily. The yuan isn't freely convertible. China's capital controls prevent it from being reserve. You can't be reserve if people can't freely move money. The euro is second most held. But Europe has deep problems. Aging population, no unified fiscal policy, energy dependence. It's fragmented. Gold is gaining appeal. Central banks are buying more gold than any time since the 70s. But gold can't scale to handle trillions in daily transactions. There's not enough. Some think the replacement won't be a single currency but a basket, IMF special drawing rights. Or technology enables something new, a digital currency backed by commodity or algorithm. Bitcoin maximalists think crypto will replace fiat, but governments won't voluntarily cede control to decentralized systems. The most likely scenario is a messy transition, a period of multipolar competition. Several regional currencies, dollar in the Americas, euro in Europe, yuan in Asia, gold for settlement between blocks. It wouldn't be clean, volatile, unstable, economically painful. But that's how transitions happen when there's no clear successor. Now let me show you why this matters to you. Why understanding this isn't academic, it's survival. When reserve currencies collapse, it doesn't just affect governments. It destroys ordinary people's wealth. Portugal's collapse in the late 1500s caused depression across the empire. Merchants holding reals saw wealth evaporate. The Dutch collapse devastated Amsterdam's middle class. Savings in guilders lost value. Investments became worthless. Britain's collapse after World War II impoverished a generation. British citizens holding pounds, government bonds, pensions, they all lost purchasing power as the currency devalued repeatedly. And the American collapse is happening in slow motion. Every dollar you hold is losing purchasing power. Since 2020, the dollar has lost roughly 25% of its value through inflation. Your savings, paycheck, retirement, if denominated in dollars, buys 25% less. And this is just the beginning of stage 6. If the pattern holds, the next decade will see accelerating decline. More inflation, more loss of purchasing power, more nations dumping dollars. And when stage 7 arrives, when the replacement happens, there will be a currency crisis. The dollar could lose 50% of value in months. This happened to the pound in 1949. It can happen to the dollar. So, what do? First, understand that holding dollars is a risk, not a safe haven, a risk. The dollar is losing reserve status slowly now, but accelerating. Diversify out of pure dollar exposure. This doesn't mean abandon dollars. You need them to live, but don't hold all wealth in dollars. Hold assets that preserve value across currencies, real estate, productive businesses, commodities. These hold value regardless of currency. Second, watch the indicators of stage 6. Watch central bank reserve data. If you see accelerating declines in dollar reserves, that's confirmation the transition is speeding up. Watch trade agreements. If major nations start settling in other currencies, that's a sign. Watch gold prices. If gold surges, the world is fleeing fiat generally. Third, understand this isn't about politics. It's not about whether you like American policy. It's mathematics. The same mathematics that destroyed the real, guilder, and pound. Every reserve currency follows the same 7 stages. The dollar is in stage 5, moving into stage 6. The pattern doesn't care about exceptionalism, military power, or economic size. It cares about deficits, debt, and debasement. The dollar is following the script perfectly. Let me show you something that should terrify you. The timeline. Portuguese real, 80 years, 1450 to 1530. Dutch guilder, 80 years, 1640 to 1720. British pound, 105 years, 1815 to 1920. Each currency lasted roughly 80 to 110 years. The dollar achieved reserve status in 1944. That's 81 years ago. We are at the average lifespan and exhibiting every symptom of late-stage decline. Massive deficits, debasement, loss of confidence, search for alternatives. The pattern says, what comes next? Stage 7, replacement. But here's what's different this time, and this is genuinely different. Every previous collapse was regional. When the real collapsed, it affected Portugal and partners. When the guilder fell, Northern Europe. When the pound collapsed, Britain and Commonwealth. But when the dollar collapses, it's global. The dollar is embedded in every economy, every central bank, every transaction, every commodity price. Oil, gold, wheat, all priced in dollars. When the dollar loses reserve status, there's no part of the global economy unaffected. This means the transition will be more chaotic than any previous shift. There's no replacement ready. The scale of dollar-denominated debt globally, over 70 trillion in bonds alone, means a dollar collapse triggers defaults on every continent. Emerging markets that borrowed in dollars won't repay. Corporations with dollar bonds face bankruptcy. Developed nations holding dollar reserves will see central bank balance sheets implode. The systemic risk is orders of magnitude larger than 1949 or 1780. This isn't just currency transition. It's restructuring the entire global financial system. And restructurings are never smooth. They're painful, chaotic, destructive to existing wealth. Let me be clear about what I'm not saying. I'm not saying the dollar collapses tomorrow, becomes a failed state. I'm not saying panic and sell everything. What I'm saying is the pattern exists. The dollar is in stage 5, entering stage 6. The timeline says maybe 10 to 20 years before stage 7. Maybe less if it accelerates. Can break the pattern. But breaking the pattern requires something no previous reserve currency managed. Reversing deficits, stopping money printing, rebuilding productive capacity. These aren't just policy choices. They're politically almost impossible because they require short-term pain for long-term stability. And democracies don't vote for pain. They vote for comfort, stimulus, printing money to avoid hard choices. So, the pattern continues. Stage 6 accelerates into stage 7, and the people who understand this position themselves accordingly. They diversify out of pure dollar assets. They hold real assets. They watch the indicators. And when stage 7 arrives, when replacement happens, they're not caught holding collapsing currency. They're holding assets that maintain value across currencies. This is what Portuguese merchants did when the real collapsed. They shifted to Spanish silver. This is what Dutch bankers did. They moved wealth to London. This is what British elite did after World War II. They moved to dollars and dollar assets. And this is what smart money is doing right now. Not all at once, not in panic, but systematically, quietly, over years. The reserve currency death pattern isn't conspiracy. It's a historical cycle documented across 6 centuries. 7 stages, 4 currencies, and now a 5th. The only question is whether you see it before it completes, or whether you become the liquidity that transfers wealth to those who did. The pattern is clear. The timeline is evident. The dollar is in stage 5. And history says stage 6 and 7 follow, not as possibilities, as probabilities bordering on certainty. This is how reserve currencies die, not with invasion or catastrophe, with mathematics, slow, then fast, ignored, then undeniable. And by the time everyone sees it, the transition is complete. So here's the number I promised you at the beginning. The number nobody's talking about, 58%. That's the dollar's current share of global reserves, down from 72%. 14 percentage points in 2 decades. The British pound lost 40 percentage points in 15 years during its collapse. We're tracking the same curve, just earlier in the acceleration phase. Stage 6 is here, stage 7 is coming, and the only choice you have is whether you see it or ignore it. Because the pattern doesn't care either way.